Today, we're going to talk about a pretty wild story unfolding in the world of finance. You could almost call it a romance. It's about what happens when the oldest money on the planet meets the newest technology, when Wall Street met DeFi. And, well, before things got too serious, it asked for a very, very modern kind of prenup.
I mean, really think about that. On one side, you have these absolute titans of finance, built on centuries of rules and tradition. And on the other, you have this disruptive, decentralized, move fast and break things world of blockchain. So when these two finally collide, the outcome isn't just interesting, it is literally reshaping finance as we know it. Let's get into it. So first up, let's meet the two main characters in this whole saga. On one side, you have the established old-school giant. And on the other, the revolutionary newcomer who's threatening to flip the whole table.
And right away, you can see the fundamental clash. I mean, it's a tale of two completely different systems. You've got Wall Street, centralized, permissioned, you need to be invited to the party. It's built on legacy systems that have been around for decades. And then there's DeFi. It's the polar opposite. Decentralized, totally permissionless, anyone can join, and innovating at a breakneck speed. You can see why this was never going to be a simple love at first sight kind of deal.
So this relationship didn't exactly start with a bang. It was more of a slow burn, you know? It began with a lot of curiosity, sure, but also a huge dose of skepticism, especially from the traditional finance side. Let's look at how they kind of first started circling each other. The very first move was tentative. Super tentative. Institutions weren't jumping headfirst into these super complex DeFi protocols. No way. They just dipped a toe in the water. They started with what you might call the gateway investments, the two big names everyone on the planet knew, Bitcoin and Ethereum. At first, it was just seen as a wild, speculative bet. But that, my friends, was about to change. And you can see the evolution right here. It's wild. It started with just widespread skepticism, right? People were laughing it off. Then you had a few brave companies, the first adopters, putting crypto on their balance sheets. But the real, honest-to-goodness turning point? That was 2023. With the approval of major ETFs. That's when Wall Street went from just watching from the sidelines to actually getting in the game.
So after buying a little Bitcoin and Ethereum and seeing that the sky didn't fall, Wall Street got bolder. It started looking past the big names and staring directly at DeFi protocols. And this is where the real drama, the real opportunity, and the real challenges kicked off.
So what was the big pull? I mean, why would these massive, risk-averse institutions even bother with this new, kind of scary world? Well, it really boiled down to three massive promises. First, getting access to totally new pools of money, or liquidity. Second, a level of transparency that traditional finance just can't even dream of. And finally, the promise of incredible efficiency, all powered by these things called smart contracts that just automate everything.
And this was the billion-dollar question, wasn't it? For these institutions built on risk management, compliance, and total control, could they really operate in what everyone was calling the Wild West of DeFi? A world of open source code and anonymous developers? The culture shock was just immense.
Let's just break down that dilemma, because it's a big one. The opportunity was huge. Total transparency, brand new ways to get yield, and insane efficiency. But the challenges were just as scary. You had to deal with open source code, extreme volatility, like stomach-turning volatility, and an almost complete lack of the rules and regulations they live by. It was the ultimate risk-reward calculation.
For this whole thing to work, for this relationship to actually go somewhere, they couldn't just accept the way things were. They had to build something totally new. They had to build a bridge between these two universes. This is the story of that smart contract prenup. And the solution that started to pop up was this new category, regulated DeFi. You can think of it like a hybrid. It takes the super fast, innovative engine of DeFi, but then it wraps it in the familiar, safe, and secure framework of compliance that institutions absolutely need to even think about getting involved. It's an attempt to get the best of both worlds. And look, this isn't just some theory. It's actually happening right now. Take platforms like Aave Arc or Compound Treasury. These are huge, well-known DeFi lending protocols that have created special, separate versions just for institutions. Think of them like VIP lounges or walled gardens inside the bigger DeFi world, creating these KYC-compliant spaces where big money can play safely. And it's not just about them using other people's platforms either. The really big players are building their own stuff in-house.
You've got JP Morgan with its Onyx division, Goldman Sachs with a whole digital asset desk, and Fidelity becoming a leader in crypto custody. This proves it's not just a fad, it's a deep strategic move towards making blockchain a core part of their business. So the bridge has been built. Traffic is starting to flow both ways. What does this all mean for the future of finance? What does this new blended landscape even look like? Well, the impact is profound. This flood of institutional money brings three things that, frankly, DeFi desperately needed to grow up: massive scale, way more stability, and a whole new level of credibility in the eyes of the rest of the world. This is what's taking the entire space from a niche hobby to a global financial force. But let's be real for a second. The story's not over. There are still major hurdles. Regulatory uncertainty is the big one. It's this giant shadow hanging over everything. Then you've got different rules in every country, mind-bendingly complex tax questions, and these brand new questions about systemic risk that nobody has the answers to yet. But let's look ahead, because this is where it gets really mind-blowing. Picture this: pension funds. We're talking about retirement money being allocated directly into algorithmically managed liquidity pools, earning yield in a completely automated, transparent way. Or what about this? The bonds that fund our roads and schools. What if they were issued, traded, and settled as unique tokens, or NFTs, on a public blockchain? We're talking about making essential public finance faster, cheaper, and more accessible. This is not science fiction anymore. And this whole convergence is about to hit hyperdrive. Imagine throwing other powerful technologies into the mix. AI to manage risk, amazing privacy tools like zero-knowledge proofs to verify things without revealing secret data, and tokenizing real-world stuff like real estate. At that point, the lines between traditional finance and DeFi just basically disappear. Which leaves us with one last massive question to think about. As these two worlds merge, are we actually seeing the beginning of a truly more open, more efficient, and more inclusive financial system for all of us? Or are we just watching Wall Street put on a new, high-tech costume to play the same old game? That, right there, is the question that's going to define the next decade of finance.